Peter Gaylord. I'm the CEO of Gaylord and Belinsky Wealth Management, and today I'd like to talk to you a bit about market crashes. We've seen a couple major instances of this in the past decade or so, namely the NASDAQ and tech stocks in the early 2000 period, and more recently the financial crisis of 2008. And in a moment I'm going to show you a slide that shows the magnitude of those drops. The first 49% for the S&P 500, just using that as an illustrative, and 52% in 2008 for the S&P 500 during the financial crisis, or just after the financial crisis. And of course the NASDAQ in similar terms was about 5,000 or over 5,000 in March 2000 before it experienced a major drop. So I'm going to show you this slide for a moment of the S&P 500 since World War II, and then we'll come back and talk about it a bit. Thanks. So welcome back. I hope you found that slide to be insightful. As you could see from it, the market tends to have periods of running up and then sell-offs, oftentimes of 20, 30, 40, or even 50%. We certainly saw a couple of those in the last decade or so, with a fall of 49% for the S&P 500 in the early 2000s and a decline of 52% following the financial crisis of recent years. This sort of begs the question if there is any way to see these sorts of crashes coming. Of course, we don't have a crystal ball, and nobody does. But we do subscribe to the theory that you can see when irrational exuberance is occurring, and it's better to get out of the market much earlier and even forego some gains than to stay in too long and suffer those significant losses. My personal experience illustrates a couple of these. In the early 2000s, I was working in the tech industry. I actually worked in the tech industry through much of the 90s. And I had invested in a lot of the tech stocks that really were booming in that day. Yahoo, Cisco, and many of the other firms that were very popular in the late 90s. I invested in a lot of those in 1996, 97, 98, and subsequently saw increases of 3, 4, 500% in a lot of the stocks that I held. In the 99 time frame in particular into early 2000, we really saw the NASDAQ taking off, and in particular in the second half of 99 we saw the NASDAQ run up from about 2,500 to over 5,000 in just 6 months. That was the point at which I started getting really nervous. I had invested since the early 80s. I knew that markets didn't behave that way. Certainly seeing a market double in a 6-month period was a warning sign. And so I subsequently sold all of my tech stocks in March of 2000 when the NASDAQ was over 5,000. Stayed in cash while the market tumbled and avoided that loss. More recently, I was essentially all in cash as the financial crisis hit in 2008. And it sort of begs the question there if there were any warning signs. Well, there were a couple. A couple that stand out in my mind was a great article that I read in 2004 in Barron's where they talked about the value of the portfolios held by Fannie Mae and Freddie Mac. And that particular article highlighted the fact that the portfolios really were substantially overvalued, but the agencies didn't have to declare the losses because the accounting rules allowed them to amortize those losses over a very extended period, which sort of masked the underlying shaky condition of those mortgage-backed securities. So that was an early warning sign. Another important event that stands out in my mind were the Bear Stearns funds that went under in 2007. These were funds that had invested heavily in asset-backed securities. And that was about a year before the crisis really hit in earnest in September of 2008. So I think these issues highlight the fact that you really can see some warning signs if you're paying close attention. And secondly, not to get caught up in that exuberance. You know, our philosophy is that it's better to sell out early and you know, give up those gains that can be realized towards the end of a big run up than it is to stay in too long and suffer a major sell-off. You know, if you lose half of the value of your portfolio, you've got to subsequently have your portfolio double in value just to get back to where you were. So avoiding major losses is really critical, probably even more important than trying to, you know, swing for the fences every time you invest. So that's certainly our philosophy. We do think that when these sorts of issues arise, you can see problems coming, you can act. If we see that happening, we're going to act early. So we hope that you know, you share this philosophy. If you do, we would love to talk to you. If you want to learn more about our approach here, our strategies, our beliefs, you can look at some of our other videos here on YouTube. Follow us on Twitter at Gaylord Belinsky, or just contact us by phone. The contact information is in the comments section of this video, and we look forward to speaking with you. Thanks very much.